All right, today we're breaking down the latest from ComScore. And wow, was this a wild quarter. We're talking about a report that had a little bit of everything. A revenue beat on one side, but on the other, a huge earnings miss that tanked the stock. And as if that wasn't enough, there's a massive financial restructuring in the works. So let's unpack this whole thing.
And I mean, the market did not wait to give its opinion. The reaction was swift, it was decisive, and it was brutal. The stock just cratered, dropping over 10% on huge volume. So what on earth happened to scare investors that badly? Well, to figure that out, we got to dive into the numbers. At first glance, these results are confusing. They almost feel like they contradict each other. You see this small win on the revenue line, but it was just completely swallowed up by a shocking loss on the bottom line. And that, right there, is where this whole story really gets interesting. Okay, let's look at the main figures here. Revenue, $88.9 million. It just barely squeaked by what the analysts were expecting. But honestly, you can almost forget that number. Just look at the earnings per share. Wall Street was modeling a profit of 91 cents. Instead, ComScore delivered a loss of 86 cents. That is a staggering miss of almost $1.80 per share. And just to rub salt in the wound, adjusted EBITDA fell over 11%. Ouch. And this slide, I think, just captures the internal battle perfectly. On one side, you have these genuine bright spots. I mean, double-digit growth in local TV and a 20% jump in their cross-platform solutions. That's fantastic stuff. But then you look at the other side, and all that good news was just erased by the collapse in profitability and a really painful cut to their full-year revenue forecast, now down to just flat. So let's go a level deeper. If we're going to really get what's going on here, we have to look under the hood. We need to see this tug of war that's happening between ComScore's new, exciting products and its older legacy businesses. And what's really fascinating here is you can see the mix shift happening right before your eyes. That 20% growth in cross-platform solutions, that is the future of this company. But it's in a constant fight against the drag from those declining legacy products. This internal battle is really the key to understanding the ComScore story right now. So, to win this battle, management is basically betting the farm on its new platform. It's called ComScore Content Measurement, or CCM. The CEO is pitching this thing as the holy grail for the media industry, a solution to the puzzle of tracking viewership across every single screen you can think of. The goal here is, well, it's ambitious, but it's what the market is demanding. They're trying to create a single source of truth for viewership, whether it's on your old school TV, a connected TV app, or on your phone. It promises to tell advertisers exactly who is watching what and where, without accidentally counting the same person multiple times. And they're already signing multi-year deals, which is definitely a good sign. So the vision is solid, right? It's compelling. But this quarter, that vision ran smack into a very real, very unexpected problem. And you gotta give them credit. Management was very direct about this on the earnings call. They said the entire slowdown was because one single, large retail client decided to suddenly change its strategy. And this didn't just hit them late in the third quarter. They expect it to drag on results into the fourth quarter too. It's a pretty stark reminder of just how risky it can be to depend too much on any single customer. Okay, so moving beyond just the quarterly numbers, there's this massive financial restructuring going on in the background that is absolutely critical to understand where this company is headed. This isn't just about operations anymore. This is about financial flexibility and, frankly, survival. So the company announced this pivotal deal, a nearly $264 million recapitalization. It's designed to completely overhaul its balance sheet and simplify what has been a pretty messy financial structure for a long time. So what even is a recapitalization? Well, in the simplest terms, it's a big swap. The company is taking this expensive preferred stock, which kind of acts like debt because it has these mandatory dividend payments, and it's trading it in for common stock. And the whole point of doing this is to free up a ton of cash flow. And the benefits here are pretty substantial. Right off the bat, this deal stops over $18 million in cash from just walking out the door every single year in dividend payments. That is cash that can now be reinvested back into the business, into products like CCM, to actually drive growth instead of just servicing old financial obligations. But, and this is a big but, this financial fix is not free. The trade-off is some pretty significant dilution for all the existing common shareholders, because a whole lot of new shares are going to be issued. And this creates that classic investor dilemma. Do you take the pain of dilution now for the promise of a healthier, more flexible company down the road?
So, with all that said, what does this actually mean for the stock? Let's get to our final call, what you should be watching for next, and our official rating on the shares. All right, there are three key things to keep your eyes on. First, and this is the big one, is the shareholder vote on this recapitalization plan. That's a huge hurdle. After that, early next year, we'll get our first look at the 2026 outlook, which will tell us if management thinks growth can actually pick up again. And of course, day in and day out, we need to see hard proof that they're actually gaining market share. So, here it is, our official call. We expect a pretty flat fourth quarter as that client issue continues to be a problem. The stock will probably be stuck in neutral, just treading water until that recapitalization vote is done and dusted. For that reason, we're kicking off our coverage with a market perform rating. Look, the long-term story has potential for sure, but the execution risk that this quarter revealed is just too high for us to ignore right now. Now, for those of you looking for a specific idea, here's something to consider, but only after the recap is approved. It's a classic pairs trade. You buy ComScore stock, and at the same time, you short a basket of its slower, more vulnerable competitors. It's really just a pure bet that ComScore's newly cleaned up balance sheet will let it run circles around the competition. And that really leaves us with the final critical question. This entire story really boils down to this. Is fixing the finances enough? Can a cleaner balance sheet finally unlock the true value in ComScore's data and let them win in the brutal media measurement wars? Or is the execution risk in this hyper-competitive market simply too high? This is not financial advice.